Welcome to today's video, where we will unveil 5 extraordinary methods utilized by the affluent to build wealth. Methods that often elude those with limited financial means. Remember, wealth creation is within your reach, and by embracing the strategies described in this video, you can unlock a path to financial abundance. And if you're new to this channel, I invite you to hit that subscribe button to join our community and embark on a journey of wealth transformation. Let's get started. Method number 1. They track everything. One essential method employed by the wealthy is their diligent tracking of every financial transaction in their lives. While the average person might draw a blank when asked about the percentage of their income spent on living expenses or entertainment last month, the rich understand the significance of tracking their financial activities. Surprisingly, 61% of American adults do not employ any form of budgeting. But the wealthy know that budgeting and the tracking of spending are crucial for financial success. The first step in this process is determining the expected income for the upcoming month. This includes salary, business income, and potential returns from investments. This total figure serves as the starting point for employing the popular 20-30-50 budgeting method. Under this technique, the income is divided as follows. 50% is allocated to living expenses, such as rent, utilities, and groceries. 30% is earmarked for entertainment costs, like dining out or going to the movies. 20% is diligently saved and directed to a savings account. Once the budget is established, the wealthy take meticulous care to track their spending. Many millionaires connect their credit cards to apps like Mint, which automatically categorize purchases into budget categories. Others opt for a more traditional approach, using the Notes app on their phone to manually record and tally their expenses at the end of each month. Regardless of the method, the key is to track and measure their financial transactions. As the old adage goes, what isn't measured isn't managed. While you might not feel the urgency to track your spending when your income is not substantial, it's crucial to cultivate good financial habits early on. As someone who follows this channel, I know that you have ambitions of attaining wealth in the future. Therefore, it's essential to develop the necessary skills to handle the significant financial transactions you'll encounter when cashing those million-dollar checks in the future. Remember, tracking your expenses and managing your finances is a valuable habit that can lead you on the path to financial prosperity. So start early and embrace the discipline of tracking your spending, as it is an essential step toward achieving your financial goals. Method number 2. They employ financial discipline. Financial discipline is a key trait embraced by millionaires on their path to wealth. It permeates every aspect of their journey to prosperity. Whether it's pursuing a high-paying job or building a successful business, discipline plays a crucial role. To attain a high-paying job, one must have the discipline to invest years in acquiring a quality education through intense studying and preparation. Similarly, entrepreneurs need discipline to focus on their businesses while their peers are out enjoying social activities. As wealth increases, financial discipline becomes even more essential. Regardless of income level, the ability to save is paramount in achieving wealth. It requires discipline and the willingness to prioritize long-term financial goals over immediate gratification. For instance, opting to drive a car you've had for a decade instead of splurging on an expensive sports car showcases the discipline necessary for saving. Major financial books and successful entrepreneurs consistently emphasize the importance of saving as a foundation for long-term wealth. However, statistics reveal a concerning reality. CNBC reports that 57% of Americans have less than $1,000 in their savings accounts, with 39% having no savings at all. While saving money can be challenging, there are methods to facilitate the process. One effective approach is to set up automated deductions. Personally, setting up automated deductions with my employer was a game changer. It allowed a portion of my paycheck to be directly deposited into a savings account, ensuring regular savings. Initially, I allocated 10% of my after-tax income to savings, but over time, I increased it to 20%, doubling my monthly savings. Another way to boost savings is by increasing your earnings. Your savings potential is directly linked to your income. While cutting costs is a good start, there's a limit to how much you can reduce your monthly expenses. To take your savings to the next level, focus on the other half of the equation, increasing your earnings. In my video on how to make $100 a day with no money, I discuss simple yet effective methods such as tutoring, freelancing, or driving for ride-sharing services. Earning an extra $100 a day can make a significant difference. If you save 75% of that extra income each month for a year, you could accumulate an additional $27,000 in savings. Remember, becoming rich is not just about saving money, it's about making it too. Embrace financial discipline, prioritize savings, and seek opportunities to increase your earnings. By doing so, you'll be on your way to achieving both financial stability and prosperity. Method number 3. They live within their means. Another crucial method employed by millionaires is living within their means. While the image of wealthy individuals splurging on designer clothes and luxury cars may come to mind, the reality is that most millionaires are responsible spenders who prioritize financial prudence. They have amassed their wealth by avoiding lifestyle creep. The term lifestyle creep refers to the tendency for people to increase their spending as their income rises. For example, someone earning $50,000 a year may be content with a standard sedan. However, if their income suddenly doubles, they might be tempted to upgrade to a luxury vehicle. This rise in spending can be attributed to Parkinson's law, which states that work expands to fill the time available for its completion. In the financial context, it means that expenses tend to increase to match available funds. Unfortunately, schools rarely teach essential real-life skills such as budgeting and financial control. While students learn about concepts like finding the slope of a line or writing in cursive, they are often left without the practical knowledge needed to create and maintain a budget. Unless one is fortunate enough to receive guidance on sound financial principles from family or friends, they may encounter money management issues later in life. Living below your means is particularly crucial for business owners. Running a business entails both prosperous times of significant revenue and challenging times of decline. If you consistently spend beyond your means during good times, you will be ill-prepared to weather economic downturns. This can lead to financial hardship and even bankruptcy for your business. Living within your means is not about deprivation or sacrificing your quality of life. Instead, it's a mindset of making thoughtful choices and prioritizing long-term financial stability over immediate gratification. By embracing this practice, you lay the groundwork for implementing further wealth-building strategies and achieving lasting financial success. Method number 4. They put their money to work. One of the key strategies employed by the wealthy is putting their money to work. Life can be likened to a game of Monopoly, where owning valuable properties on the board generates substantial income over time. These investments not only provide ongoing cash flow, but can also be sold for a significant lump sum in the long run. However, acquiring such investments requires available cash, which is why the rich prioritize investing. Unfortunately, when the average person receives their income, they typically spend it or simply deposit it into a savings account. While saving money is certainly better than squandering it on frivolous expenses, relying solely on a savings account does little to grow one's wealth. The average savings account yields a mere 0.09% interest annually. For instance, if you have $50,000 in savings, you would earn a paltry $45 in interest over the year. This is precisely why the wealthy make a point to put their savings to work through investing. The sooner one begins investing, the better. Consider the example of Warren Buffett, who purchased his first stock at the age of 11. Through strategic investing over several decades, he has become one of the wealthiest individuals in the world. Investing consistently is a fundamental part of the wealth accumulation strategy for millionaires, with an average of 20% of their household income being allocated to investments each year. Contrary to popular belief, millionaires often invest in similar vehicles as the average investor, such as Roth IRAs and 401k retirement accounts. However, they also go beyond these conventional investments, diversifying into areas like real estate properties and personal development. By expanding their investment portfolio and exploring various opportunities, they maximize their potential for long-term wealth growth. It's a powerful strategy that leverages the concept of compounding and the growth potential of different asset classes. Whether you're a billionaire like Warren Buffett or an everyday millionaire, investing plays a pivotal role in building and expanding your financial prosperity. Method number 5, they never touch the principal. One of the key distinctions between the rich and the poor is that the wealthy never spend their principal. While some millionaires may indulge in luxury purchases, this doesn't deplete their wealth or make them poor. The principal refers to the original amount of money invested. For example, if someone buys stocks worth $100,000 with an annual dividend of $2 per share, the $100,000 is the principal, while the $2 per share, or $20,000, is the dividend income. The rich understand that they should never diminish the assets that generate income for them, ensuring that their wealth remains intact. Renowned author Robert Kiyosaki, known for his book Rich Dad, Poor Dad, alluded to this spending approach in a recent tweet. He advised people to live it up and buy everything they want with one caveat: buy the assets that can pay for those purchases. Kiyosaki himself utilizes a portfolio of investment properties to fund his lifestyle expenses, such as vacations or buying a new car. Unfortunately, most people rely on active income, which is earned by trading time for money. When you only earn active income, any money you spend directly reduces your wealth. Income that is not invested will never grow to a point where it can generate excess cash. To combat this, the rich focus on generating passive income through various investments. Some popular passive income methods include investment properties, dividend stocks, and real estate investment trusts, or REITs. Investment properties allow you to invest in buildings, generating cash flow through rental income. Dividend stocks provide regular payments without reducing your invested capital. REITs, on the other hand, are like mutual funds for real estate investing. By buying stocks in a REIT, you earn a share of the profit generated by the real estate investments owned by the company. This allows you to invest in real estate without the responsibilities of property ownership, such as maintenance and dealing with tenants. Reinvesting these payments back into your original investment is where you will see the exponential growth of your money through compound interest. In summation, if you want to continue growing your wealth while enjoying occasional spending, it's crucial to get to a point where you only spend the income generated by your assets and never touch the principal. By focusing on generating passive income and investing wisely, you can maintain your wealth while still having the financial freedom to enjoy the fruits of your labor. To learn more about investing and wealth creation, do check out our next video and subscribe to our channel for money-making tips in the days to come. Thank you for watching.